Welcome to today's deep dive. We are doing a quick hit data forward breakdown, talk tickers style.
Right, getting straight to the numbers.
Exactly. Our mission today is slicing through the heavy jargon of U-Haul's Q4 2026 earnings call, ticker symbol UHAL. We want to give you, the retail investor, the exact data you need to know if this stock is a buy, a hold, or, just a total fold.
And U-Haul is such a fascinating case right now. I mean, if you just glance at the top line summary on your brokerage app, it honestly looks like a disaster.
Oh, a total disaster. Like, Dyer's putting it mildly. Let's just rapid fire the headline numbers so you can understand the exact panic Wall Street was reacting to.
Yeah, lay it out.
So their fourth quarter net loss actually widened to $128 million.
Ouch.
Yeah, that's a loss of 65 cents per share. And last year, the same quarter, it was a loss of 41 cents a share, so noticeably worse.
Right, and the full year numbers are even scarier.
Exactly. Full year earnings cratered. I mean, they dropped from $367 million down to just $83 million.
Which is, the kind of metric that makes algorithmic trading models just smash the sell button.
Totally.
Because a drop like that usually signals that the core business is just breaking down, right? Like people stopped moving or renting storage.
Right, that's the instinct. But we have to pivot away from that scary JAP net income number and look at the actual cash generation.
Yes, the cash is what matters here.
Because when you look at adjusted EBITDA for their moving and storage segment, it actually increased by $6 million for the quarter. It hit $223 million.
Which is wild.
Right. So here is the core mystery for this deep dive. How does a company lose significantly more money on paper but simultaneously generate more operating cash?
Well, to understand that disconnect, you really have to look under the hood at what U-Haul was buying a couple of years ago.
Right. We have to go back to, 2023?
Exactly. So imagine you go out and buy a luxury car at peak pandemic markup. You pay way over a sticker price.
Oh, yeah. The supply chain was a nightmare. You're paying a huge premium.
Exactly. Now imagine trying to trade that exact same car in today.
You'd take an absolute bath on the trade-in value.
Precisely. And that is exactly what happened to U-Haul, but on a massive corporate scale with their cargo van fleet. Fleet depreciation is the main culprit for this entire earnings drop.
Wait, so the vans are just bleeding value?
Right. Depreciation is basically a phantom weight dragging down their net income. In Q4 alone, truck depreciation spiked to $221 million.
Wow.
Yeah, that's up from $181 million last year.
So that's a $40 million swing in just one quarter.
Exactly. And it's because U-Haul bought all these high-cost 2023 and 2024 model year vans. And, they expanded their broader box truck fleet by over 14,000 units.
That is a staggering amount of vehicles to buy when prices were that inflated.
It really is. And the thing is, cargo vans operate on a really fast life cycle for U-Haul. They keep them for about a year, take the heaviest wear and tear, and then try to sell them.
Let me guess, they are trying to sell them into a secondary market that is completely dead right now.
You nailed it. The resale market is super weak. Nobody is paying those pandemic-era premiums anymore. So U-Haul is forced to just crank up the depreciation rate on their books to match reality.
Okay, I get that. It's a non-cash expense, but they still lost that economic value. But let me push back a bit here.
Sure.
So the fleet is bleeding value on paper, but what about the actual business of renting out the trucks and the storage spaces? I mean, is the core business failing?
That's the crazy part. It's absolutely not failing. The fundamental strength is just being masked by all this depreciation.
Okay, hit me with the data.
Well, equipment rental revenue actually went up $12 million for the quarter.
Even with the housing market totally frozen right now.
Exactly. Mortgage rates are high, existing home sales are sluggish, but U-Haul is still growing their rental revenue. And storage revenues were even better, up 7%, which is about $16 million.
That's seriously impressive. But wait, I flagged a metric in the source material that looked super concerning.
Occupancy, right.
Yeah, their same-store occupancy dropped 540 basis points. It fell down to 86.1%. Like normally in real estate, if occupancy drops that fast, it means everyone is fleeing.
It looks like a massive red flag for sure. But this is where management provided some crucial context on the call. It's the difference between physical occupancy and economic occupancy.
Okay, break that down for me.
So 450 basis points of that drop was a completely intentional cleanup.
Wait, intentional?
Yeah. U-Haul basically went in and evicted a massive chunk of non-paying delinquent customers.
Oh, wow. So they just kicked them out.
Exactly. I mean, a storage unit with someone who hasn't paid rent in 3 months, is a liability, not an asset. It generates zero cash.
Right, and it blocks you from renting it to someone who will actually pay.
You got it.
Oh.
Yeah. So it makes their physical occupancy look way worse on the earnings report, but economically, it frees up roughly 35,000 rooms for paying customers.
That is huge.
Yeah.
So then they just swapped out dead weight for prime inventory.
Exactly. And they are charging a 3% year-over-year rate increase for new tenants right now.
Okay, so the core business is actually throwing off cash. Which brings us to, honestly, what I thought was the biggest bombshell from the entire call.
The buyback.
Yes, the board of directors authorized a massive $350 million share repurchase plan.
Which is wild because U-Haul historically almost never buys back stock.
Right. They are empire builders. They usually just plow every spare dollar into buying more land and more trucks.
So what does a $350 million buyback signal to Wall Street? First, it means management genuinely believes the stock is cheap right now.
Obviously.
But more importantly, it marks a massive strategic pivot. After years of aggressive growth, they're officially hitting the brakes on fleet expansion.
Okay, let's get into the specific forecast numbers for that. How hard are they hitting the brakes?
Extremely hard. For the next fiscal year, there is zero planned growth for the truck fleet. Zero.
Wait, really? None?
None. They're only going to replace older units. And because of that, net new equipment purchases are estimated to drop by $560 million.
$500 million just staying in the treasury.
Exactly. They are shifting from a cash-burning growth phase into what you could call a cash-returning digestion phase. They built the capacity, and now they were just going to let it generate cash.
That shows so much discipline. And actually, speaking of discipline, I have to bring up this funny anecdote from the Q&A section of the call.
Oh, the Wendy's thing.
Yes. So an analyst on the call pitches this idea. They tell management, hey, you have 200,000 trucks driving around, essentially giant rolling billboards. Why not sell side panel ads to brands like Wendy's or Coca-Cola?
It sounds like a great idea on paper.
Right. The analyst estimated it could be worth potentially $500 million a year in pure profit.
Which most CFOs would kill for.
Literally. But U-Haul management just flatly rejected it. They walked away from $500 million to protect their brand image.
I mean, their trucks are their proprietary advertising space. Wrapping them in a fast food logo totally dilutes the brand and it confuses the customer.
And they made a good point about local zoning, too. Like a U-Haul parked in a driveway is fine. It's just a neighbor moving. But a giant neon billboard parked there, that gets banned by HOAs immediately.
Exactly. They are fiercely protective of their core product.
So with the fleet shrinking, capital expenditures dropping, and these buybacks beginning, we need to give the listener a final verdict.
The talk ticker's ruling.
You got it.
Yeah.
Are you bullish, bearish, or neutral on UHAL?
I am taking an opinionated stance here. I am cautiously bullish, but specifically for the patient investor.
Patient because the accounting is still going to look ugly for a bit.
Right. The ugly earnings are basically an accounting hangover from those past fleet purchases.
Yeah.
It's not a fundamental breakdown in consumer demand. They still have to sell those 2023 vans.
Sure, but the downside is so mitigated now.
Exactly. With capital expenditures dropping by $500 million and a $350 million buyback putting a firm floor on the stock price, the cash flow story is getting so much stronger.
It really is. So to wrap up this deep dive, I want to leave you, the listener, with a final provocative thought to just mull over.
Go for it.
If U-Haul has spent the last 3 years aggressively building the largest storage and fleet capacity they've ever had and is now simply waiting to fill it, what happens to their profit margins in the next 12 to 24 months?
That is the big question.
Right. Once that heavy depreciation naturally rolls off the books and those 35,000 empty units start generating pure cash flow, those margins could absolutely explode.
An incredible setup to watch.
Definitely. So keep your portfolio sharp, stay disciplined, and thank you for joining us on this deep dive.